Decision trees offer a structured approach to navigating complex decision-making processes inherent in product design, particularly useful when there are a series of decisions and outcomes that lead to subsequent decisions followed by other outcomes. Decision trees provide a visual representation of possible pathways and their associated probabilities. By mapping out various decision points, potential outcomes, and their probabilities, decision trees enable designers to systematically evaluate different design options, anticipate potential risks, and make informed decisions to optimize product designs for success. This presentation explores the application of decision trees in product design, highlighting their utility in guiding design iterations, prioritizing design features, and ultimately enhancing the overall quality and performance of product. This diagram is a tree structure. It is a diagrammatic representation of a tree data structure with a root node, the square, and the child nodes, the circles, which is common in computer science to illustrate hierarchical data, family trees, or organizational structures. Decision tree analysis in product design follows a structured procedure to evaluate various alternatives and potential outcomes. The key steps include decision trees should encompass all potential alternatives and states of nature relevant to the design problem, including the option of doing nothing or maintaining the status quo. Assign payoffs or outcomes to each end node of the decision tree based on the consequences associated with each alternative and state of nature. These payoffs represent the benefits or costs resulting from specific design decisions. Calculate the expected value of each branch by weighting the payoffs by their respective probabilities of occurrence. This involves multiplying the payoff of each outcome by its probability and summing these values across all possible outcomes for each branch. Once the expected values of each branch are determined, prune the decision tree by identifying and selecting the alternative with the highest expected value. This process helps prioritize design options based on their potential outcomes and associated probabilities, guiding decision-making towards the most favorable solution. By systematically applying decision tree analysis in product design, designers can methodically evaluate design alternatives, assess their potential risks and rewards, and ultimately make informed decisions to optimize product designs for success. This is a decision tree, which is a decision support tool that uses a tree-like graph or model of decisions and their possible consequences, including chance event outcomes, resource costs, and utility. Here's a breakdown of the components in this decision tree. Decision nodes. These are represented by squares. The decision maker has control over these nodes. In this tree, there are two decision nodes. The first decision node represents the choice to purchase CAD or computer-aided design software. The second decision node gives a choice between hire and train engineers and do nothing. Chance nodes, represented by circles. These nodes are where a chance event will occur with certain probabilities. In this tree, after purchasing CAD, there is a chance of having a high sales with a probability of zero point 0.4 or low sales with a probability of zero point 0.6. After hiring and training engineers, there is again the possibility of high sales with a probability of zero point 0.4 or low sales with a probability of zero point 0.6. Outcomes. These are the ends of the branches which represents the final result of a decision path. Probabilities. Attached to the branches following the chance nodes, these numbers indicate the likelihood of each event occurring. In both cases, the probability of high sales is zero point 0.4 and low sales is zero point 0.6. A decision tree is typically used to evaluate the expected values of different actions by considering the likelihood of different outcomes and their associated rewards or costs. It's a visual and an analytical decision support tool that helps to understand the possible consequences of making certain choices. In business contexts, this kind of analysis can be very useful for strategy planning and risk management. This is a decision tree commonly used in decision analysis to help identify a strategy most likely to reach a goal. It's a visual representation of the decision-making process, showing various choices and their possible outcomes, including chance event outcomes, resource costs, and utility. Here's the breakdown of the decision tree in this diagram. At the first decision node, there are two options: purchase CAD and do nothing. If the decision is to purchase the CAD computer-aided design system, there is a chance node that follows, indicating there's uncertainty about the level of sales that will be achieved. There are two branches: high sales with a probability of zero point 0.4 or 40% and low sales with a probability of zero point 0.6 or 60%. For high sales, that is zero point 0.4 probability, the revenue is $2,500,000, which might be from selling 25,000 units at $100 each. The manufacturing costs are $1,000, perhaps $40 per unit. The CAD system costs $500,000, and the net outcome from high sales is $1,000. For low sales, 0.6 probability, the revenue is $800,000, which might be from selling 8,000 units at $100 each. The manufacturing costs are $320,000, again perhaps $40 per unit. The CAD system costs $500,000, and the net outcome from low sales is a loss of $20,000. The expected monetary value EMV for the decision to purchase the CAD is calculated by multiplying the probability of each outcome by the monetary outcome of that event and then adding them together. EMV is equal to 0.4 into $10 lakh plus 0.6 into $20,000, that is minus $20,000. EMV therefore is equal to 0.4 into $10 lakh plus 0.6 into minus $20,000. This calculation is a way to determine the expected value of the decision, accounting for the different probabilities and outcomes. It's a key part of decision analysis, particularly in financial or business context where decisions have to be made under uncertainty. The do nothing branch has only one node related to it, labeled low sales, but there's no additional information provided about the financial implications of that choice. This decision tree is emphasizing the decision-making process involving the potential purchase of the CAD system and not on the alternative of doing nothing. This is a decision tree analysis for a business decision involving the purchase of a CAD, computer-aided design system. Here's the breakdown of the analysis. Decision to purchase CAD system or do nothing. The business has two choices, either to purchase a CAD system for $388,000 or to do nothing. The probable outcomes are, if the business decides to purchase the CAD system, there are two potential outcomes. High sales with a probability of 0.4, that is 40% chance, or low sales with a probability of 0.6, that is 60% chance. If high sales occur, revenue would be $2,500,000. Manufacturing costs are calculated at $40 per unit for 20,000 units, totaling to $1,000,000. CAD costs, the investment in the system, are $500,000, and therefore the net profit in this scenario would be $100,000, that is $100,000. If low sales occur, revenue would be $800,000. Manufacturing costs are calculated at $40 per unit for 8,000 units, totaling to $320,000. CAD costs remain the same at $500,000. This scenario would result in a net loss of $20,000. Expected monetary value, that is EMV calculation. The EMV for purchasing the CAD system is calculated using the formula EMV is equal to P high sales into profit high sales plus P low sales into profit low sales, where P high sales is the probability of high sales, that is 0.4. Profit high sales is the net profit from high sales, that is $100,000. P low sales is the probability of low sales, that is 0.6. And profit low sales is the net loss from low sales, that is minus $20,000. Plugging the numbers in, EMV therefore is equal to 0.4 times 100,000 plus 0.6 times minus 20,000. Therefore, EMV is equal to $400,000 minus $12,000. Therefore, EMV is equal to $388,000. In the do nothing scenario, the alternative is to do nothing, which typically would have an EMV of $0 since there is no additional cost and no additional revenue. In conclusion, the decision tree is showing that if the business purchases the CAD system, the expected monetary value EMV of this decision is $388,000, taking into account the different probabilities of high and low sales and their respective financial outcomes. This is a simplified analysis and doesn't take into account other factors such as the time value of money, other indirect costs or benefits, and risk tolerance of the business. This is a more complex decision tree analysis that includes an additional decision node for hiring and training engineers compared to the previous scenario. Here's a breakdown. initial decision. The business is considering whether to purchase a CAD system for $388,000 or to do nothing. Outcomes of purchasing CAD are high sales, probability of 0.4, revenue of 2,500,000 from sales, that is $100 per unit for 25,000 units. Manufacturing costs will be $100,000, $40 per unit for 25,000 units. CAD cost is $500,000, and therefore net profit is $100,000. Now for low sales, probability of 0.6, revenue is $800,000 from sales, $100 per unit for 8,000 units. Manufacturing cost is $320,000, $40 per unit for 8,000 units. CAD cost is $500,000, and net loss is $20,000. Now the next decision is to hire and train engineers. If the company decision to hire and train engineers. If the company hires and trains engineers for an additional cost of $365,000, there are two potential outcomes. High sales of probability 0.4 that will generate a revenue of $2,500,000 from sales of $100 per unit for 25,000 units. Manufacturing cost will be $1,250,000, $50 for units for 25,000 units, suggesting increased cost per unit due to the engineers. Hiring and training costs of $375,000, the difference from the original CAD cost, and net profit of $875,000. The second option is low sales, probability of 0.6, that will generate revenue of $800,000 from sales, $100 per unit for 8,000 units. Manufacturing cost is going to be $400,000, $50 per unit for 8,000 units. Hiring and training cost is going to be $375,000, and net profit of $25,000. The last option is do nothing, which would result in $0 net profit or loss, as there are no associated costs or additional revenues. This decision tree introduces the cost and potential benefits of investing in human capital engineers in addition to the CAD system. The manufacturing cost per unit is higher when engineers are hired and trained, suggesting a qualitative improvement or a more expensive manufacturing process. However, in both the high sales and low sales scenarios, the net profit is lower when hiring and training engineers compared to just purchasing the CAD system. This suggests that while there is still a profit to be made, the additional investment reduces the overall net gain in both scenarios. The decision tree helps visualize the choices and potential financial outcomes to assist the business in making an informed decision. Transitioning from product development to production is a critical phase in the life cycle of a product. Here are key considerations for a smooth transition. Know when to move to production. Product development is often viewed as an evolutionary process, but it's essential to recognize when a design is matured enough to transition to production. While perfection may be elusive, a timely transition to production ensures that the product can meet market demands and stay competitive. Many products undergo a trial production period to validate their manufacturability and address any unforeseen issues. This phase allows for adjustments to tooling, quality control processes, and workforce training to ensure a smooth transition to full-scale production. Develop tooling and quality control. Tooling such as molds, dies, and fixtures must be developed or refined to support efficient manufacturing processes. Quality control measures should be established and integrated into production workflows to maintain product consistency and meet quality standards. Training and readiness. Comprehensive training programs should be implemented to prepare production personnel for their roles and responsibilities. Ensuring that the workforce is adequately trained and equipped with the necessary skills and knowledge is essential for successful production. Transitioning to production requires careful planning, coordination, and execution to mitigate risks and ensure the success manufacturing of the product. By addressing key aspects such as trial production, tooling development, quality control, and workforce readiness, organizations can streamline the transition process and set the stage for efficient and effective production. Transitioning to production involves more than just technical considerations. It also entails a shift in responsibilities and management approaches as the product progresses through its life cycle. Here are some key points to consider. Shift in responsibility. As the product moves from the design phase to production, there is a transition in responsibility from design teams to line management. Line management assumes responsibility for overseeing the day-to-day operations of production, including scheduling, resource allocation, and quality assurance. Three common approaches are often employed to manage the transition effectively. Project managers play a crucial role in coordinating activities and ensuring that timelines and milestones are met during the transition phase. Cross-functional product development teams may continue to be involved in the transition process to provide ongoing support and expertise. Some organizations opt for a more integrated approach where product development and manufacturing functions are closely aligned or merged. This integration facilitates seamless transitions and fosters collaboration between design and production teams. Integrating product development and manufacturing organizations can enhance efficiency, communication, and coordination throughout the product lifecycle. By breaking down silos and promoting cross-functional collaboration, organizations can streamline processes and accelerate the transition to production. Managing the transition to production requires careful planning, clear communication, and effective collaboration between various stakeholders. By adopting appropriate management approaches and fostering integration between design and production functions, organizations can ensure a smooth transition and maximize the success of their products in the marketplace.